We just witnessed one of the most crazy days in stock market history. NVIDIA stock sold off nearly 17%, wiping out $600 billion of market value. And that was just one stock. Overall, trillions of dollars of market value was lost. Broadcom fell 17%, TSMC fell 13%, and ASML sold off 5%. But why? China's top AI lab, DeepSeek, released a new model called R1, which matched the performance of high-end models from US companies like OpenAI at a small fraction of the cost to both train and use. This made investors believe that demand for high-end AI chip hardware may decline in the future, with those stocks selling off most. Now, a day removed, the market is starting to rebound and these tech stocks are gaining again. But should you target these sold-off stocks or be cautious? Today, I'm going to share my thoughts on the news and give my top 3 tech stocks to buy now. That will cover 3 tech themes: AI hardware, AI-powered software, and AI usage. On top of that, I'll share breaking commentary on DeepSeek from leading US tech CEOs like Tesla's Elon Musk, Microsoft's Satya Nadella, and OpenAI's Sam Altman. With that said, let's dive into the video. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. Throughout, I'll be using my stock research tool over at dividenddata.com. This is designed to help you find better investments. We give great data visualizations so you can understand the full financial picture of a business. You can see the journey all the way from top-line revenue to earnings and free cash flow, then all the way down to the dividend. We also have our own AI analyst where you can ask questions about any stock and it will help you understand its business model. You can even ask about breaking news and how that impacts the market, such as China's DeepSeek model, and screen for stocks using hundreds of different financial metrics. And a little bit of a spoiler alert for later in the video, news like what came out with China's DeepSeek only actually helps small tech startups like myself because it means our AI will get smarter and cheaper in the future. If you want to try out dividenddata.com, we have an exclusive 7-day free trial, which is only going to be available for a few more days. To access it, you have to use the link in the description and pinned comment of this video. But let's pivot away from how I use AI. Before I get to my top 3 stocks, let's break down the news around China's DeepSeek and how I think this will impact the whole AI and tech market. But obviously, this sent a shockwave in the entire stock market, most notably around AI stocks like NVIDIA. The big question is around future AI spend and whether or not it's even necessary. After all, NVIDIA's profits is the cost of other companies like Microsoft. They spent $45 billion in capital expenditures last year, and that's expected to ramp up to $80 billion in 2025. This China DeepSeek news really just poked a hole in the entire narrative around AI. That spend is going to go up significantly in the coming years. For example, just last week, Donald Trump had OpenAI and Oracle at the White House to announce a $100 billion investment this year in AI data centers in what they call Project Stargate. That was privately funded, by the way. And they were saying that that could go up to $500 billion over the next 4 years. Now the question is whether that's necessary at all. Even President Trump is talking about the DeepSeek news, saying they may end up spending less. And although he's a little on the old side and not really into tech, he actually had a pretty good takeaway from the situation that I'll carry into some of my farther analysis. So let me play this clip from last night.
Some of the companies in China, one in particular, coming up with a faster method of AI and much less expensive method. And that's good because you don't have to spend this much money. I view that as a positive, as an asset. So I really think if it's fact and if it's true, and nobody really knows if it is, but I view that as a positive because you'll be doing that too. So you won't be spending as much and you'll get the same result, hopefully.
So yeah, you'll spend less. And I actually think this is the right takeaway from the perspective of people who are just looking at AI to increase future productivity more generally. Cheaper is actually awesome. And you even have Microsoft CEO Satya Nadella thinking around that exact same line of logic. He put out this tweet, "Jevons paradox strikes again. As AI gets more efficient and accessible, we will see its use skyrocket, turning it into a commodity we just can't get enough of." So what's Jevons paradox? It occurs when technological advancements make a resource more efficient to use. However, as the cost of using the resource drops, overall demand increases, causing total resource consumption to rise. And this has actually been the entire goal of investing large amounts of capital in AI. Yes, to make a more intelligent model, but also to make it more cost efficient, because in order for it to be abundant and used everywhere, it needs to be affordable. So Microsoft CEO Satya Nadella is actually bullish on this news on the usage of AI. But what does this mean for US model companies? Sam Altman, the CEO of OpenAI, just tweeted, DeepSeek's R1 is an impressive model, particularly around what they are able to deliver for the price. We will obviously deliver much better models, and also it's legit invigorating to have a new competitor. We will pull up some releases, meaning they will likely release their O3 model very soon, which is far more intelligent than this DeepSeek model that just came out, but it won't be as cost efficient. He also said that he believes compute is more important now than ever before. The world is going to use a lot of AI. And to use Satya Nadella's logic, where the model becomes a commodity, that ultimately will not be the value that OpenAI provides. Their value will be in the product, ChatGPT, and the other applications they develop of AI in the future. In my opinion, that will be the long-term value of the company. And they have a lot of room to develop that, considering they have hundreds of millions of active users. However, you have other, more skeptical big tech CEOs. For example, Elon Musk replied to a tweet of a CNBC interview from last week, which aired right after the R1 announcement came out. And in that interview, the CEO of Scale AI implied that DeepSeek was lying about the low cost and lack of resources used to train their model. He says that DeepSeek had around 50,000 NVIDIA H100s they got through Singapore. These high-end GPUs aren't allowed to be sold directly to China, but 20% goes to Singapore. So it's likely that a lot of those are going through backdoor channels into China and likely to this AI lab. Elon Musk replied to the tweet with one word: obviously. It should be noted that perhaps he is somewhat biased, as he is taking the approach that scaling laws is going to be the #1 factor when reaching the frontiers of AI models, both in terms of intelligence and cost efficiency. And his new company, xAI, just built the largest AI data center in the world, and they are about to finish training on their Grok 3 model. So we will know very soon whether or not scaling laws are still very important. And if we are just reading social dynamics here, Elon tweets a crazy amount, and he hasn't really talked about this DeepSeek thing that much. So I have a feeling that the truth is going to be a little bit in the middle. Yes, we will find lower cost, more efficient models, and over the long term, Jevons paradox will lower the cost of AI. But also, scaling laws are definitely a thing. And to get artificial general intelligence and artificial superintelligence that these companies are trying to reach, they're going to need to throw way more compute at this while also making more efficient and innovative models. So given that context, let's go to the top 3 stocks. Those will be across 3 different themes: AI hardware, AI powered software, and AI usage. For stock number 1, I'm going to go with the obvious, which is NVIDIA. It's down 20% from its 52-week high. It had one of the largest sell-offs yesterday, and it's already starting to bounce back. So let's get to the stock analysis. But first, I'm going to share the bear case so that you can skip along if you agree with that. The bear case is that demand for NVIDIA's high-end GPUs is going to go down for AI data centers. And the logic there is that spend is going to come down as models are becoming more efficient. More specifically, less money is going to go into training, but also into inference or the usage of AI. The bear case there is that lower powered computers and older hardware will be able to run these models. Also that they could be so efficient they could be run locally and not in these large AI data centers. That would be the bear case. And if you think that's right, you don't want to buy NVIDIA stock here. However, if we go to my opinion, at best, I think that's partially right, but I think will prove to be wrong over the coming years. And there's a few reasons why, both on training and usage. On the training side, I think in a few weeks, we're going to realize that scaling laws definitely still are a thing, and this whole narrative might shift again. But at the same time, more efficient models and cheaper usage of AI is actually a good thing in terms of demand. Total usage will increase from that as more applications and people can use AI at a more affordable price. And that's been the entire premise of why companies like Microsoft are investing so much in AI capital expenditures. Last week, Microsoft CEO Satya Nadella said that he's still good for his $80 billion of spend, and I don't think that has changed. Even if model usage becomes far more efficient, they will still need all of the compute for the increased demand load. And I think that's still true for the vast majority of large big tech companies that are doing their AI spend right now. It is almost guaranteed that 0 of those people will be canceling their orders from NVIDIA. It's very unlikely to happen. And instead, they will actually likely keep buying more over the next few years. So if you believe that premise to be true, then the AI hardware stock you want to buy is NVIDIA. And the reason why I'm picking that over Broadcom is that this is a pure play on AI, and they have a much better business model. As you can see, their earnings per share have increased rapidly over the past 2 years, and this rise in price has been backed up almost entirely by earnings growth. And they're still expected to grow at a high rate in the future. So their forward-looking PE ratio isn't even that high right now. Now, again, that's assuming earnings don't decline. And with this recent sell-off, NVIDIA stock is now trading far below the consensus Wall Street price target as of last week. Let us remind ourselves that NVIDIA is a company with 74% gross margins and 55% net margins. They themselves have extremely low capital expenditures as they get their chips manufactured by TSMC, so they don't have to build chip fabs themselves. So virtually all of their profits go to free cash flow. That makes NVIDIA right now a money printing machine for investors. NVIDIA is also a pure play on the data center business. Now 88% of the revenue comes from that data center segment. In the latest quarter, that's up to $30.8 billion. You can see the crazy growth of that segment's revenue over just the past 2 years. Again, this is only set to increase in 2025. The question is about the years beyond that. And if you're a person who buys into that bull case I described earlier, then NVIDIA stock is actually a far better investment today than it was last week. And the reason is you can buy it at a $2.9 trillion valuation compared to $3.5 trillion. That means you get to own more of the company for what you pay. And if analysts are correct about future growth estimates, then you're buying the company at 21 times 2027 earnings. That's really not a bad deal for an extremely high margin company with a wide economic moat, especially when there's potential for high growth beyond that. But again, I will reiterate that that is somewhat risky because the future demand for these AI data centers is unknown. And this recent news around China's DeepSeek only increased that unknown risk. So be sure to do your own research on this before making any investing decisions. Stock number 2 that I'm sharing today is in the AI-powered software category. And the primary example I'm going to give is Salesforce, ticker symbol CRM. And Salesforce is a company that benefits from cheaper and more efficient models. The market even started to realize that yesterday as they gained 3.96% on the day where most tech stocks were selling off. And the reason why is that this is an existing high-quality software business. They have extremely fast-growing earnings per share with projected high growth in future years, and they are bringing the power of AI to their customers in the real world. Over the long term, I think that the value produced by AI will go to those who provide value to the end user. As Satya Nadella mentioned, the model itself will be a commodity. The end value will likely not go to the model company or the hardware behind it. It will go to the value they produce for people in the real world. Salesforce gets to use the advancements in AI, but they don't have to front any of the capital expenditures in building these large data centers. Salesforce actually hasn't increased their CapEx at all in this AI boom. Instead, they get to just benefit from the innovation. And that's where a lot of the AI winners will be. Salesforce already has a great business. In fiscal 2024, they generated $10.2 billion of cash from operations and $9.5 billion of free cash flow. They're growing free cash flow per share at a 25.98% 10-year compound annual growth rate. They are so profitable now that they started paying a dividend payment. And what's exciting is we'll know soon whether they become a dividend growth stock of the future. Salesforce is a great business. And the value of a stock ultimately comes from the cash flows produced by the actual business underneath it. A stock is not just a price that goes up and down. It's a real business with real profits. And in the AI future, there will be a lot of opportunities for companies to use AI to enhance their business, provide more value to customers, and ultimately monetize that even more. So Salesforce is one example that fits that theme. Another could be Adobe, which is a high-growth subscription software company. They are integrating AI throughout their entire product suite. They also are down 30.9% from their 52-week high. So in terms of profit multiple, Adobe is certainly a very interesting company to look at. Their projected high earnings growth into the future. So I'll put them as an honorable mention in this AI software category. But this is a much broader theme impacting the entire world. more intelligent, more efficient, and more abundant models is going to benefit a lot of companies and individuals. So there's thousands of potential opportunities for value creation here, from large market cap software companies all the way down to the smallest startups. For stock number 3, I'm going to pick Microsoft, ticker symbol MSFT. And this is going to follow the theme of AI usage. That's because a lot of this AI demand will ultimately come through the hyperscale cloud companies, being Microsoft Azure, Amazon Web Services, and Google Cloud. If we go back to Satya's in a tweet, AI becoming more efficient and accessible will increase its overall demand. Usage in the real world will grow. That is the entire goal of why they're investing all this money into AI. And Microsoft's in a very interesting category in that they are both AI-powered software through their Microsoft 365 business and all their other software products, and even social networks, whether it's LinkedIn or TikTok, since they're one of the companies rumored to buy TikTok, but that's unknown whether that's going to happen. But more directly related to AI, Microsoft's cloud business is growing significantly, and the usage of AI through data centers is a new revenue stream for them. For example, every single time you type a prompt into ChatGPT, that runs on Microsoft Azure. So Microsoft just wants increased AI usage. So this is a new revenue stream for a business which is already in a high growth business. The cloud was going to grow anyways. AI just accelerates that. Microsoft also owns tools like GitHub Copilot, which use AI to make coding more efficient. This, along with other AI programming tools, will increase the rate of software development in the future. That means more applications and data and compute that need to be hosted in places like the data center. So all of these things snowball onto each other. So it's not just new revenue streams in cloud from AI inference. It's all of the existing ones like machine learning, web hosting, database hosting, etc. And then, as I was mentioning, Microsoft is including AI in all of their product portfolio. So they want it to be better and cheaper. And in terms of investing, Microsoft is a very high quality business. They are growing earnings per share reliably at a high rate. Revenue per share is growing at 15% 5-year compound annual growth rate. Free cash flow per share is growing at 14.86% 5-year compound annual growth rate. And that's with capital expenditures on the rise. They've nearly doubled over the past few years and are set to triple from that number. This company has a crazy strong balance sheet. They have $78.4 billion of cash and short-term investments. That's with $74 billion of annual free cash flow and $118 billion of annual cash from operations. And for us dividend growth investors, Microsoft has a 10% 10-year compound annual growth rate. They increase the dividend 10% every single year. In my personal dividend growth stock portfolio, which I cover all the time on this channel, Microsoft is my number 2 stock position, and it's a core position of my portfolio going into the future. And the reason why is because it's a great business. By the way, my dividend portfolio was actually up 0.5% on the day of this big tech sell-off. And to go along with this AI usage theme, I'm going to put the other big tech cloud companies as an honorable mention. They'll include Alphabet, who has Google Cloud. They also have plenty of AI-powered software as well, so they fit into that trend. I'll also mention Amazon with Amazon Web Services. Amazon also fits the AI-powered software trend. Oh, and so does this little thing called DividendData.com. I would also say that's in the AI-powered software trend. And speaking of that, if you want to use the tool I showed throughout the video for all of this stock analysis, it's all available at DividendData.com. And if you sign up today, you can get a 7-day free trial, which is only available in the link in the description and pinned comment of this video. That free trial will only be available for a few more days, so now is the time to try. Aside from that, if you enjoyed the video, please leave a like and subscribe to the channel. I'll see you in the next one, and let's keep investing.